Hello and welcome to the show. I'm your host, and today we are tackling a giant topic, perhaps the giant topic in global finance. We are talking about the Federal Reserve, the Fed, and its massive, almost total influence on the US dollar.
It's great to be here, and you're right, giant is the perfect word for it.
I think for most people, myself included, the Fed is this distant, academic sounding institution. But then you watch the news and the Fed chair makes a single speech, and suddenly the global markets just go completely haywire. The dollar surges, stocks fall. Why does this one institution have so much power?
That's the central question, isn't it? The first thing to understand is that the dollar, which is the currency that basically dominates all international trade, doesn't just move randomly. And behind almost every major move is the Federal Reserve.
The document you shared calls the Fed the orchestrator of the American economy.
That's a perfect metaphor. And because the U.S. economy is so large and the dollar is the world's reserve currency, the Fed is, by extension, orchestrating a huge part of the global financial system, too.
So what the Fed does doesn't just stay in Washington.
Not at all. The Fed's decisions on interest rates and inflation have direct, tangible effects on your wallet, even if you live thousands of miles from the United States. The cost of your car loan, the price of gasoline, the value of your savings, all of it can shift in days because of a decision they make. It's like a massive domino effect.
Okay, so today, let's trace that effect. I want to know what the Fed actually is, what tools it uses, and how those decisions ripple out to affect all of us. What is the Fed? Let's start with the absolute basics. For anyone who's nodded along but never really knew, what is the Federal Reserve?
It's simple. The Fed is the central bank of the United States. It was created back in 1913. But unlike your local commercial bank, the Fed doesn't serve you or me. You can't open a savings account there.
So what does it do?
Its role is strategic. It has a dual mandate. Its entire mission is to do two things at once: promote maximum employment and maintain price stability, which really just means keeping inflation in check. It's a very difficult balancing act.
The article we're drawing from had a great analogy for this. It's said to imagine the U.S. economy is a race car.
Right, and the Fed is the driver. Its job is to know when to hit the accelerator to stimulate growth and create jobs, and when to pump the brakes to control inflation so the engine doesn't overheat.
And the rest of the world is in the passenger seat?
More like we're all on the same highway and that car is the size of a freight train. When it speeds up or slows down, everyone has to react. That's the global impact.
The Fed's toolkit. So if the Fed is the driver, what's the steering wheel? What are the actual tools it uses to hit the brakes or the gas?
This is the most important part to understand because it's how we can predict the dollar's direction. The Fed's primary and most powerful tool is the federal funds rate.
This is the one we always hear about in the news. The Fed is raising rates.
Exactly, and it's just the interest rate that banks charge each other for overnight loans, but that rate acts as the baseline for everything else: mortgages, corporate bonds, your credit card interest.
Okay, so here's the key link I want to make. Why does raising that rate make the US dollar stronger?
It's a simple concept: attraction. When the Fed raises interest rates, it makes dollar-denominated assets, like U.S. Treasury bonds, more attractive to global investors. They get a higher return, a better yield.
So a pension fund in Japan or an investor in Germany says, wow, I can get a 5% risk-free return in the US. I want in.
You got it, but to buy those attractive U.S. assets, what do they need?
They need US dollars.
They need US dollars, so they sell their yen or their euros to buy dollars. This massive global demand for the dollar is what pushes its value up, strengthening it against other currencies.
And we just saw this play out perfectly.
A textbook case. During 2022, the US had soaring inflation, so the Fed, the driver, slammed on the brakes. They raised rates aggressively, and what happened? The dollar skyrocketed to multi-year highs against the euro and many other currencies.
So conversely, if the Fed cuts rates,
the dollar weakens for the exact opposite reason. Those U.S. assets are now less attractive. Investors might say the return is too low, so they sell their dollars and move their capital elsewhere, weakening the currency.
Is that the only tool, just interest rates?
That's the main one, but there's another bigger one: open market operations. This is better known as quantitative easing or quantitative tightening.
This sounds very complex.
The metaphor in the source talk is perfect. Just think of it like a water faucet for money. QE, or quantitative easing, is when the Fed injects money into the economy by buying up assets like bonds. It's opening the faucet wide. More liquidity, more dollars floating around, so...
Which means each dollar is worth less, a weaker dollar.
Precisely. And QT is the reverse. The Fed withdraws money from the system by selling those assets. It's closing the faucet. Less liquidity available usually leads to a stronger dollar.
So between rates and this money faucet, the Fed has almost total control over the dollar's trajectory.
It has immense influence, yes, and it's all in service of that dual mandate, trying to keep inflation near its 2% target, while also keeping people employed.
Historical shockwaves. You can really see this power when you look back at history. The Fed has been at the center of every major economic event for the last century.
It really has. During the 1970s stagflation, that's when you have high inflation and low growth, the Fed chair, Paul Volcker, did something incredibly painful. He raised rates to historic, astronomical levels to break the back of inflation. It worked and the dollar strengthened, but it also caused a massive, painful recession.
He hit the brakes so hard he threw everyone through the windshield.
That's one way to put it. Then fast forward to the 2008 global financial crisis, the Fed did the exact opposite.
They floored the accelerator.
Exactly. They dropped rates almost to zero and turned on that QE money faucet to inject trillions in liquidity to stop the entire system from collapsing. And they did the exact same thing again in 2020 in response to the pandemic.
So there's a clear pattern. In every major crisis, the Fed's decisions don't just affect the U.S., they send shockwaves across the entire planet. The dollar as a financial life vest. But here's something I find fascinating, a real paradox. You said in 2008 and 2020, the Fed was pumping trillions into the system, which should weaken the dollar. But in both cases, after a brief dip, the dollar, it got stronger. Why?
This is the most important concept to understand about the dollar. It's called the safe haven asset. In times of extreme panic, uncertainty, or crisis, investors don't care about yield, they care about safety. They flee from risk and rush towards the one asset they believe is the most stable and secure.
And that's the dollar.
That's the dollar. It's not just about the U.S. economy, it's about trust in the U.S. system and the Fed's ability to guarantee stability.
So when the pandemic hit and the world shut down, everyone's first instinct was sell everything, buy dollars.
Exactly. We saw the same thing when the war in Ukraine began. The dollar strengthened immediately. The source material uses a great analogy. The dollar acts like a financial life vest in a turbulent sea, and the Fed is the institution that everyone trusts to keep that life vest inflated.
That's an incredible amount of power and responsibility. It's not just managing an economy, it's being the arbiter of global stability. Okay, let's bring this all home. This is fascinating, but why does a regular person, maybe someone living in Latin America or Europe, need to care about what the Fed is doing in Washington?
Because it directly impacts your bank account and your daily life. Let's be very practical.
Please.
Okay, first, your credit costs. If the Fed raises rates, your own country's central bank may be forced to raise its rates too to stop capital from fleeing. Suddenly, your variable rate mortgage, your car loan, your credit card interest, all of it just got more expensive.
Okay, second, your savings. If you're holding your savings in a local currency and the Fed raises rates, the dollar strengthens. That means your local currency's value just went down. Your savings are losing purchasing power. A strong dollar is a better hedge.
And third, and this is the one everyone feels, the price of imports.
My smartphone, my gas.
Your smartphone, your car, the gasoline for that car, even food and medicines. So many global commodities are priced in dollars. If the dollar strengthens, all of those imported goods become more expensive for you in your local currency.
So here's the actionable tip from the source. Whenever the Fed makes an announcement, the question we should all ask is,
will this weaken my local currency against the dollar? If the answer is yes, you need to think about your budget. Maybe adjust your savings or cut back on non-essential imported goods.
This has been incredibly clarifying. The Fed isn't just a bank, it's the institution that dictates the entire pace and rhythm of the global economy.
That's the perfect summary. It raises rates to strengthen the dollar and fight inflation,
it lowers rates to stimulate growth. And every one of those decisions influences your credit, your savings, and your cost of living.
So it's not an exaggeration to say that understanding the Fed is one of the most important things you can do for your own personal financial health.
I would say it's essential. It's the difference between being a passenger tossed around by these economic waves and being an informed sailor who can see the storm coming and adjust the sails.
That's a great place to leave it. Thank you so much for breaking this down for us.
My pleasure. It was great being here.